If you had invested $1,000 in 1929, 1968, or 1999, in each of these cases, it would have become worth the equivalent of around $400 10 years later. This is a chart of the US stock market adjusted for inflation, and it shows us there is such a thing as a bad moment to be investing in the stock market. In fact, many argue that the S&P 500 is at much too elevated levels today relative to the average growth trajectory that it has seen over the last 100 years, and that investors face the same risk today as they did in 1999, 1968, and 1929, risking that they see the value of their investment go down in inflation-adjusted terms. And indeed, when we look at the returns that the stock market has yielded over the last 15 years, adjusted for inflation, currently stands at 295%. We can see that on this chart that shows the 15-year return of the S&P 500 adjusted for inflation. And a 295% return is quite extraordinary. It happened once in the late 1990s and once in the late 1960s. Again, leading many people to suggest that following these types of incredible returns, investors should expect poor returns looking forward. Now, perhaps that will be the case, but knowing exactly when these poor returns are actually going to materialize is almost impossible to anticipate. For instance, we had the same extraordinary returns that we have today in 1964 and in 1997, but you can see following these moments, the stock market continued to move higher in the few years that followed. We can say the same thing about the stock market today. Yes, it is at very elevated levels relative to its long-term growth trajectory, but the market has returned a staggering 40% since 2022, adjusted for inflation. These are fantastic returns that investors definitely don't want to be sitting out on. Now, when we zoom in and we take a look at exactly what has driven these incredible returns, one of the key factors driving this has been the fact that interest rates in the United States have stabilized over the last 2 years. We've gone from an environment where interest rates were rising very rapidly as the Federal Reserve was hiking interest rates throughout 2022. But as soon as interest rates began to stabilize, it allowed for the stock market to move higher, and this is very normal behavior. When interest rates rise by over 2% within a single month, that's usually a big drag on the stock market. On average, the S&P 500 sees a 4% drawdown when that happens. When interest rates are falling rapidly, it also tends to be a bad thing for the stock market. The perfect environment for the stock market is when interest rates are steady. And that's exactly the environment that we've been in over the last couple of years. Interest rates have gone absolutely nowhere, and so that provides a slow, steady, predictable environment for investors. And as long as the economy is growing steadily, that's a great thing for the stock market, and it's what we have today. Interest rates have been, for the most part, steady, and S&P 500 earnings, you can see right here, have been growing. So we've had that perfect combination for the stock market to do well. The question is whether that can keep on fueling more inflation-adjusted gains like we've had over the last couple of years. Well, in order for that to happen, we need to continue seeing the same environment, steady and predictable interest rates, and a steadily growing economy with growing earnings. Many argue that this is the big risk, and we could see a big decline in earnings over the next few months. In which case, this chart would look something like this, which is what happened during the financial crisis and during the dot-com bubble. Both of these saw the stock market move down by over 50%. One of the things that we're paying attention to today is the price of copper. Copper in financial markets is often known as Dr. Copper, because it's a great thing to watch if you want to gauge the strength of the global economy. And today, copper's price has been surging, for now telling us that the economy is actually very strong and not suggesting that we're going imminently into a recession. When you look at what happens to the price of copper heading into recessions, most of the time in the few months leading into the recession, the price of copper is going down. That's not what we have today. Now, this could all change quite quickly, and we actually expect that to be the case in the second half of this year. But as things stand today, copper is signaling that the economy is still quite strong, and that these steadily rising earnings that we've seen over the last year can probably continue. When it comes to interest rates, these have been rising a little bit over the last few months, which is responsible for some of the volatility we've seen on the S&P 500. Now, to provide some context, back here between October of 2023 and January of 2024, financial markets priced in that the Federal Reserve was going to cut interest rates in 2024. Over the last few months, we've seen some of that get reversed, and the market is now expecting is that the Federal Reserve is just going to keep interest rates at the same level. For now, that's really all this is. Interest rates are still hovering at around the same level they were at in November of 2022. So yes, the stock market has been spooked a little bit over the last few months. In fact, this rising interest rate risk is something that we highlighted many times to our members on gameoftrades.net, and why we expected around a 4 or 5% correction on the S&P 500 in April. But if we zoom out and we take into account the broader outlook, interest rates are still stable. So the environment that we've been in over the last couple of years doesn't quite yet seem to be coming to an end. When we zoom out on this chart of the S&P 500's inflation-adjusted returns, the big moves down that occur on the S&P 500 almost always occur during recessions. Now, we've highlighted many times why we expect a recession to begin in late 2024, but for now, a resilient economy and stable interest rates could fuel the market for another move higher. The S&P 500 has just bounced beautifully off this key price channel that we've been watching closely with our members at Game of Trades. This allowed us to accumulate quite a few nice trade at cheap prices that are already up quite substantially since. The fact that we've seen such a nice bounce off this key structure is what we were looking for to confirm our bullish bias on the market. Now, in the short term, we're not excluding the idea that the market consolidates a little bit more before resuming higher, but for now, all the metrics that we're watching to guide our equity strategy at Game of Trades are still pointing to a stronger market.